Hey guys, let's talk about the accounting cycle. So what we've been doing is taking these transactions or economic events and we journalize them. What we're doing when we keep a running total in the T accounts, we're essentially posting the journal entries to the ledger. You can think of the ledger as a bunch of T accounts. Now, throughout the next couple chapters 2, 3, and 4, we're going to learn how to do the next steps. Make a trial balance, adjusting journal entries, adjust the trial balance, finally make your financial statements, and then in chapter 4, we're going to talk about closing the books. Alright guys, let's talk about recognizing revenue and expenses. So, when do we have revenue? People Magazine here sell a lot of monthly subscriptions, but they collect the fees all at once before they actually provide the magazines. The answer is that every month in 2020, they would recognize 1 divided by 12, 1/12 of the total revenue there. In other words, they recognize it as they earn it. They have to provide the service to recognize the revenue. It doesn't matter when they get paid. That is irrelevant. Revenue is recognized as it is earned. Alright, how about expenses? Same idea applies. If you prepay for your insurance on November 1st, you don't have any expense at that point in time. 18 months, $1,800, that's $100 a month. Every month you would have an expense of $100 over the course of the next 18 months. Here's another example. Read about Best Buy here. Alright, which day do they get to recognize revenue? You got it? Let's read another one and compare. Notice the difference? In the second one, the customer pays on March 21st. Completely irrelevant in terms of revenue recognition. In either case, the relevant date is going to be March 29th. Finally, we have something called depreciation. Now you may have noticed, every time we buy equipment, we buy a building, there is no expense. You're basically trading one asset, cash, for a different asset, buildings. But there is no doubt buildings and equipment wear down and eventually become worthless. And that is the cost of doing business. So when are they expensed? Well, every year, little by little, in a process called depreciation. So in this example here, $500,000 building, gonna last you 50 years, no value at the end of its useful life. So you take $500K divided by 50, and you have depreciation expense of $10,000 every year. The accounting we're learning here, generally accepted accounting principles, is an accrual accounting system. This is very different from cash accounting. Cash accounting is, honestly, it's very primitive. You just simply record expenses whenever you spend cash. Now it's important to remember that at the end of the company's life, if you add up the net income with accrual accounting throughout all the years, it will be equal to the income under cash basis accounting. It will be exactly the same. So why all the effort? Why so much work? Well, it's all about timing. Accrual accounting is going to give you an income number which is much more representative of what you earned during the period.